Good evening, and thank you very much for participating in our webinar. The idea is to sort of give you a performance update in terms of the portfolio. So let me just kickstart directly into the webinar. If you look at Micro Marvels' journey, now it's been almost more than 12 months since we have launched the product. So what we've done in the latest information update that we have shared with you all close to about 2-3 days back. What we have done here is we've given a very detailed analysis in terms of what's happened with our portfolio companies. So if you look at the last 12 months in terms of earnings, as far as Micro Marvel portfolio is concerned, the trailing 12 months or the last 12 months earnings growth has been closer to 13%. Just to give you a context, when you look at similar market cap companies which are similar to Micro Marvel's strategy, the average market cap for the Micro Marvel portfolio is closer to 2,000 crores. Now, when we look at similar market cap companies, there is a significant earnings decline at the index level, meaning that if you were to pull out 1,000 crores to 5,000 crore market cap companies which are listed, and if you were to aggregate their earnings growth in the last 12 months, there is a significant decline in terms of earnings. And that is the case not only in the last 12 months, but also in the last quarter. So if you look at Micro Marvels as a portfolio, in the last quarter also, we have managed to report about 11% earnings growth. So the limited point which I'm trying to highlight over here is that there's a lot of pain in terms of earnings in the segment in which we are operating. Unfortunately, that could be the reason why there is lack of interest as of now in this segment. But even in this difficult market environment, our portfolio companies continue to report double-digit earnings growth. And we believe that as and when the earnings in the segment starts bouncing back, possibly our companies will outshine during that scenario. And in terms of next 6 months, we believe that this market cap segment, which is the 1,000 crores to 5,000 crore, will see some flattening out in terms of earnings. So whilst there has been a decline in terms of earnings last 1 year, we believe that over the course of next 6 months, there is a good probability that the earnings growth will not decline, but will flatten out. And starting FY27, possibly the earnings growth can really emerge. So we believe that times in terms of interest coming back seems to be a very high probability, given that last 1 year the segment has seen a lot of pain. And if we were to look at earnings, rightfully so, because generally in this kind of a market cap segment, investors will not enter unless there is a sizable double-digit earnings growth visible. So obviously, last 12 months have been a bit challenging as far as the entire bucket is concerned. And possibly that's the reason why even our portfolio hasn't sort of delivered positive returns, despite the fact that there has been a earnings growth reported not only in the quarter, but also on a trailing 12-month basis. Moving on to the next slide. Yeah, so what we did here was we were trying to figure out reasons in terms of what has led to what has happened in the last 1 year. Now, interestingly, what has happened is that there's a lot of liquidity drying up, which has happened in this segment. So if you look at some of our holdings, we've actually seen liquidity going down by as high as 50% on a YoY basis. So what has actually happened is that there is sort of significant lack of interest as far as this market cap segment is concerned. So it's not that companies are doing bad, and that's the reason why people sort of are selling the stocks. In fact, what it seems like is that despite our portfolio companies reporting earnings growth, there's still a lack of interest in terms of new buyers coming into this segment. Now, we believe that basically that can also act as an opportunity because what happens is that this segment generally is very cyclical, the microcap segment. So, if things are bad, things can also turn better if the earnings growth sort of bounces back. And just to give you a simple example in terms of why we believe that is the case, if you look at average promoter holdings in our sort of strategy, it's close to about 60 odd percent. Assuming that there are 10 to 12% strategic holders which do not want to sell, the free float is in the range of 20 to 25%. So on a 2000 crore market cap segment with a 20-25% free float, what happens is that the stock available to buy is just about 500 odd crores. So therefore, we believe that if the interest comes into this segment and if there is a buyer who wants to buy, say, 10 crores, 15 crores, 25 crores, 50 crores, assuming that there is some institutional buying as well, and they will not stop at, say, 5, 10 crores, they obviously would size it up. Clearly, they will have to pull up the price to sort of get into this segment. So, what we are trying to highlight is that as and when the liquidity comes back, obviously the interest also starts to come back. And our sense is that the first leg of interest should come in companies which have delivered strong growth and alongside strong earnings also delivered, importantly, strong cash flows. Because generally in this segment, people have a lot of fear in terms of balance sheet risks. And what we do here at Ambit is that we don't take any balance sheet risk. So in our portfolios, you will never see asset-heavy businesses like, say, power or cement or metals, oil and gas, etc. Because in a very small market cap bucket, we don't want to take balance sheet risks. So therefore, to that extent, the balance sheet for our companies continue to be virtually debt-free. More or less, whatever sort of debt will be there, majority of the debt will be primarily working capital. But at the portfolio level as well, the net debt to equity is very, very comfortable at about 0.2x. In fact, as we get into more slides, we'll show you that the balance sheet as of now is even far more stronger as compared to what it was a year back. Moving on. So if you look at a lot of people keep on asking us that microcap 250 Nifty hasn't corrected as much versus what Micro Marvels has corrected. Now what happens is that interestingly the average market cap of the microcap 250 index is far higher compared to what our market cap is. So on an average, if you look at Nifty Microcap 250, the market cap is closer to 7,300 crores, which means that it's a far bigger market cap index compared to our 2,000 crores. It's almost more than 3x in terms of market cap compared to our set of companies. What we did was we sort of looked at what has happened in the less than 5,000 crore market cap bucket within the Nifty Microcap 250 index. Now, there are close to about 45 plus companies which are less than 5,000 crores within the Nifty Microcap 250 index, which is not a small representation. It's almost virtually 20% of the index has companies which are less than 5,000 crores. And if we were to look at average performance of these particular stocks, it's down almost 31% in the last 1 year. So what we are trying to highlight is that in general in this space, the pain is far higher than what is visible at the broader index level. And I think that's the story even in the large cap indexes like, say, Nifty, where almost 50% of the index in Nifty also is down 7-8%. So what we are trying to highlight is that especially in the bucket in which we operate, which is 2,000 odd crores, obviously there is a lot more pain. Now, the question a lot of people have is that why not increase the market cap? Meaning that why not buy large market cap companies and try to minimize the drawdown. Obviously, because we are also invested, we also get, so our own money is also in the fund. So we also keep on deliberating that kind of sort of a question. But what happens is that typically, if you look at cycles, generally, there will never be sort of two consecutive years where you will see sort of such a drawdown coming in. Meaning that the probability of 2 consecutive years seeing such massive declines in this market cap bucket is a very rare probability. And typically, we are already 1 year into this. Now, again, I mean, if you were to increase the average market cap of this particular strategy, and if the interest comes back, then what happens is that you will not be able to catch up. So typically, what we do is we stick to our sort of stance of keeping this entire product micro cap focused. We are not buying larger market cap companies. And basically, if you look at the range of companies which we own, the highest market cap company which we own is actually not even 5,000 crores. So we are staying true to our philosophy in a sense, because we believe that in a space of 5 years, even if we get a good 2 years, I think a large part of the money will be made in that period. And believe me, when this strategy fires, it will not stop at maybe 15%, 16%. And I'll show you a chart wherein you will see that how the strategy has done had you sort of invested in these names for the last 5 years. So net, the messaging here is that typically there is a lot of drawdown in this particular market cap bucket. And when you compare to that, you'll see that the performance is not quite sort of inappropriate as what it feels like. Yeah, moving on. So this is a slide which we wanted to showcase in order to give you some comfort. So if you look at that, despite on a point-to-point basis, if you look at the stock prices in our strategy, obviously in the last 1 year, you will see that on a point-to-point basis, they would be down almost 20%. But despite that, had you invested in these stocks and continued investing for a 5 year period, the CAGR still continues to be 28%. Meaning that 100 rupee invested would still be 340 rupees even after such a drawdown. And you can see the kind of returns which can be made in this segment year 1, year 2, year 3, year 4. Obviously, it is very much visible, so I don't want to shout it out. But what I'm trying to highlight is that basically, if you remain true to your market cap bucket and if you ride the entire cycle, this strategy can actually make decent money. And typically, what I would also further highlight is that typically clients who can also use these drawdowns as an opportunity to top up typically will sort of stand to even further accelerate their returns. Because the reason why I'm emphasizing on top-ups is because had the strategy reported a 20% earnings decline and had the portfolio also gone down 20%, we would have sort of even justified. But despite the portfolio reporting a decent double-digit earnings growth, the portfolio continues to remain in the red. That shows that there are also other reasons which are contributing to the portfolio performance apart from the fundamentals. Moving on. Yeah. So, as I told you that we'll also share in terms of how the balance sheet has shaped up. So, if you look at the cash flow generation of the portfolio in the in the first half compared to first half last year, the strategy has actually reported a 42% growth in terms of operating cash flow, which means that the balance sheet has become far more stronger. And when I say cash flow, these are real cash profits. So typically, companies which report a higher growth in cash flows versus a higher growth in earnings are generally rewarded in a rational kind of a market environment. So versus a 13% PAT growth, typically a 42% cash flow growth implies that the working capital management for a large part of our companies has also been fairly strong. And that means that the balance sheet equally has been very strong. And unlike the fact that a lot of our in general, the capex spending is lower at the economy level, but our companies continue to still incur capex. So there is a 13% growth in capex as well versus a 42% growth in operating cash flow. The reason why the capex growth is is slightly lower is because a large part of the capex for our companies has also been incurred last year. So the reason why we like these companies is because a large part of the capex has already been done, and as these capex get into commissioning mode, obviously what happens is that the revenue growth starts accelerating, and more importantly, the free cash flow starts accelerating that much higher. So to summarize this slide, the balance sheet continues to be far more stronger 1 year down the line in our journey of investments. Also, a lot of our companies have seen very sizable strengthening as far as the top management is concerned. A few of the companies we've listed here. So, if you look at Teamlease, Suparna Mitra, who was the head of Titans watches business and spent more than 15 years in that company. She was instrumental in turning around the watches business from being losses into sizable profits. After spending more than 15 years with Titan as the CEO of the watches business, has now been appointed as the MD and CEO of Teamlease. Now, this is a sizable sort of an addition because working for Titan, which is such a larger company, and coming to work with Teamlease, which is such a small company, shows that clearly she's seeing a much brighter future in a company like Teamlease. So we thought that we'll highlight this in terms of addition. It's a much sizable kind of addition as far as the talent pool is concerned. Likewise with IceMake, so Mr. Srinivas Reddy, who was working with Blue Star for almost 29 years as the head of corporate strategy, has decided to join IceMake Refrigeration as their CEO. Now again, this is a sizable addition. IceMake is just a 1200 crore market cap company, and a person who's worked with Blue Star, which is such a large company, for as long as 29 years, joining as the CEO is a sort of a great achievement for IceMake because they are able to attract such sort of talent. And why we believe this is a stepping stone in the journey of IceMake is because if you look at the capex which IceMake has done in the last 2 years, they have never done such kind of capex in the history of their company. So they are clearly at a very strong inflection point, and the addition of Mr. Reddy as the CEO clearly will help the company scale up and utilize that capex in a far more better manner going forward in terms of revenue growth. So clearly, I mean, from an addition perspective, we thought that it's important to highlight our listeners in terms of what kind of talent pool our portfolio companies are dealing with. Thirdly, if you look at insecticides India, it was sort of a large part as a promoter-run company. But if you look at the recent announcement which they did during the second quarter results, it's a sizable addition to their talent pool. So Mr. Devinder Kumar Ray, who was associated with PI Industries and was looking after their manufacturing for a sizable period of close to 10 years, obviously has joined Insecticides India as the Chief Operating Officer. Now, what this will do is this will free up the bandwidth of the promoters who are also looking after manufacturing. So, what will they do with that bandwidth? My sense is that they will significantly focus now on sales and more so exports. So, if you look at the first half as well, you are seeing that there is a sizable growth in exports, obviously on a low base. But we believe that the exports, which is just about 2% of revenue, should see significant growth coming in from countries like Japan, Europe, US. A lot of agrochemical companies are looking at boosting up their CDMO business. And now that they are free from their manufacturing responsibilities, we believe that there can be significant progress happening on this front. And I think as this share of export rises, what will happen is that the cyclicality in the business will actually reduce a lot. Secondly, your EBITDA margins in exports and working capital is far more conducive versus the domestic market. So, to that extent, your return on capital employed should see a significant improvement. And more importantly, this could actually lead to re-rating of valuation multiples. So, if you look at the company's valuation, which is less than 15 times PE last 12 months, I'm not talking about future, I'm talking about trailing 12 months. I mean, there is a case to argue that if the business cyclicality reduces and the balance sheet and the return ratios improve, there is a case that there could be a lot of valuation re-rating in the company. Fourthly, if you look at Bajaj Healthcare, they have also recently announced the addition of Mr. Shri Kumar Nair as the Chief Operating Officer. So Bajaj Healthcare again has sort of significant tailwinds. They're looking at building up a big export-oriented CDMO business. Clearly, they need good talent to sort of boost their aspirations, and the addition of Sri Kumar clearly is a big positive, given that he's come from working with Alembic and Glenmark, which are far bigger companies compared to what Bajaj Healthcare is. So I think we are very optimistic on Bajaj Healthcare as far as FY27 is also concerned, because we believe that the drivers of growth will be very different from what the current drivers are. And clearly, this addition will go a long way in terms of boosting up their aspirations. Eveready Industries also sort of has seen a new CEO. Obviously, it's an internal transfer, but clearly, I mean, from the business ignition perspective, this should fuel a lot of growth. Remember, Eveready is going through a big transformation phase. They are the first company in India to set up alkaline battery manufacturing. And if you look at the revenue potential of the factory which they are setting up, and which is likely to get commissioned maybe in the next 2-3 months, it's almost a 600 crore kind of a revenue potential. Please note that the alkaline revenues of Eveready are not even 60 crores. So they are significantly sort of entering into a transformation phase. Almost 170 plus crores of capex has been incurred into this factory. And more importantly, another development which Eveready has seen is the removal of embargo. So there was embargo on Eveready pertaining to the older cases where they were not able to give any ESOPs, and hence not able to attract talent, and also not were able to liquidate their non-productive assets. But now with this embargo getting lifted, obviously they can sort of start looking at liquidating their unproductive assets, which means that whatever debt is there on the balance sheet possibly that debt can be entirely paid off if those liquidation of assets go through, and that process has already started. You can see a lot of VRS payments being given in the first half. After a very, very long time, everybody has initiated this kind of a proceedings. So clearly, from a balance sheet perspective, going forward, you should see a balance sheet significantly strengthening in this company. And with the entering into alkaline, clearly that's a step in the right direction. In the last 2 years, the company has already seeding this business. They're already seeing more than 25% growth in the alkaline business because they've been advertising a lot. The brand using reputed brand ambassadors as well. So clearly, they are on a transformation phase, and we believe that this internal promotion which they have given to their battery business division head into a CEO is a step in the right direction. Platinum Industries is another company which has seen a good addition in terms of talent pool. So Anand Mahadevan joins from Honeywell Automation. He's basically a chemical engineer passed out from UDCT. We believe that, and I think yesterday they did announce a German scientist also being added to their sort of esteemed talent pool. Dr. Frank has been appointed as a talent pool as far as platinum is concerned. And here again, they have incurred significant capex in their Palghar facility in the last 1 year. And as they look to scale up that facility, already as we speak in the quarter, the commissioning has already happened in the second quarter, and the revenue has already started flowing through. So, I mean, as they enter into the next phase of capex, getting commissioned, obviously these kind of additions will help them. We believe that there's a good possibility that they may enter into newer and newer chemistries because the kind of talent pool which they are hiring obviously seems to suggest that they have plans to diversify their current revenue stream. So clearly, this again is a step in the right direction. Net, what we're trying to highlight is that smaller companies in India are also starting to see talents coming in from very, very large companies, because a lot of these companies are also looking at issuing ESOPs. So there's a lot more ownership when you join a smaller company with ESOPs compared to working as an employee in a larger company. So there are enough sort of long-term incentives which these companies are ready to dole out, and hence the talent pool seems to be coming through. What happens when smaller companies see such talent pool is there is a behavioral change in the DNA of the company, which is seen when such kind of people join the company, because clearly from a promoter-owned company to a more professionally owned company, that journey shows a lot more valuation re-rating. Obviously, it doesn't happen immediately, but over time, it translates into better disclosures, better return on capital employed, because they start imbibing the practices of larger companies into such smaller companies. So clearly, one of the traits which we watch out for is the addition of new talent pool in smaller companies, because the valuations for our strategy at 17 times 1 year forward in terms of PE suggests that the strategy is due for a valuation re-rating as well, led by behavioral changes, which you can see from the kind of talent pool which is getting added. Moving on. So I think broadly, the messaging which we are trying to relay over here is that we will continue to communicate with you every quarter in terms of a detailed information update. If you look at the latest information update, it's almost a 14-15 page report. Company-wise, we have given you what happened in the quarter, and company-wise, we have also given you what are the key catalysts which we are waiting for as far as next year is concerned. And I would sort of urge you to go through these kind of documents, because these are your companies. You've invested in these companies. We are a custodian, but obviously you are the owners. So I mean, you will get a lot more details. We write a lot, and Basically, we also publish full-fledged reports. We've already done on three companies. We also invite our companies to speak to you, in a conference kind of a format. So I would urge you if you could also come to such conferences going forward. So there's a lot more effort which goes into into our portfolio companies. And that's the reason why you haven't seen much of changes which we have done in the last 1 year, because these companies continue to deliver. Though the times may be bad, but the performance may not be that bad. Basically, as the cycle turns with more interest coming into this market cap bucket, possibly we'll get rewarded.